Most folks honestly have no clue what's heading our way with XRP, and that probably includes you. But today we're looking at insights from someone who's actually nailed it before, Tom Lee. Now, while his original take was on tech stocks, what he said about the economy pushing forward through all the chaos still holds serious weight. After a strong bounce back in crypto, stocks and other markets, Tom's offering up some sharp thoughts on what might be coming next. His breakdown is spot on, and I think a lot of you will walk away from this with valuable takeaways. We're going to unpack everything: how I'm positioning myself, how Tom Lee is navigating the current landscape, and what others are doing right now to shape their financial future. Quick heads up, this isn't financial advice, so check the disclaimers. Tap that like button to help get this out there. And now let's hear from Tom Lee himself. So Tom, how did you spot something the rest of us completely missed? Honestly, I was bracing for everything to crash to zero. Well, Brian, Tom replied, zero is technically always on the table, but there were three big indicators that helped me see things differently. First off, the high-yield bond market didn't echo the level of panic economists were screaming about. Yeah, spreads widened to around 439 basis points, but if we were staring down a real recession, they would have exploded to around 700. They've already come back down to roughly 360. That's a good sign. Secondly, yes, the stock market took a nosedive, but here's what people forget: almost every sharp drop since 1950, 17 out of 18, was followed by a quick V-shaped recovery. The outlier was 2022, and that was mostly due to the shock from Jackson Hole. Finally, we had strong conviction in the strength of businesses. These companies have been through the ringer and came out tougher. Would you like a similar rewrite for the rest of the transcript if more follows? They weathered a full-on economic shutdown during the pandemic. They powered through the chaos that came with a whiplash recovery, and they stayed standing through the most aggressive rate hikes we've ever seen. So yeah, companies deserve some serious recognition for hanging tough and still managing to post solid earnings, even in Q1. Their forward guidance blew expectations out of the water, especially when everyone was bracing for financial doom. That's why we told our clients to hold firm, and in some cases even increase their positions. Now Kelly, I did something I rarely do. I deleted a tweet. Around that time I'd posted something like, "You haven't really lost money until you sell." I meant it then, and I still mean it now. That tweet was kind of a gut reaction to another show I'd watched on a different network, claiming retirees were being financially wiped out. I was frustrated, and that tweet took off in a way I didn't expect. But the real message I was trying to get across was this: unless you're about to retire very soon, like in the next year, or you're quite advanced in age, you're better off staying invested rather than trying to time every bump in the road. If you're a hedge fund or a day trader, sure, it's a different game. But for long-term investors with a 5-year horizon or more, history shows the market tends to reward patience. Now, we also think the downturn had a heavy political tint to it. It wasn't just about economic fundamentals. Would you agree with that? Yeah, there were definitely multiple dynamics in play. We started pointing this out during the whole tariff drama a while back. A big chunk of equity investors, over 60% according to political surveys, tend to lean Democrat. So naturally they viewed moves from the White House through a negative lens, which led to a stronger reaction in stocks than we saw in bonds. Meanwhile, in the bond world, the numbers flip: about 60% of fixed income managers lean Republican. That contrast is probably why the bond market sent a more stable signal during all of this. And don't forget the 10 best days effect, something we've been emphasizing for a while. If you missed just the 10 strongest market days in 2023 or 2024, your returns would have shrunk to a mere 3% annually. Staying in the game is the only way to capture the real gains, like the 20% rallies we've seen. Just look at what happened this year. People panic sold when the S&P hit 4,835, and now watching it roar back, they're trying to buy in again. The problem? They've already missed out on a huge one. 0.00 surge, or about 20% worth of upside in 2025. So where do bond yields fit into all of this? Do they matter right now? That's a fair question, especially for those who sat on the sidelines wishing they'd jumped in at the bottom last month. And now that stocks are right back near the highs, they're hesitating again, scared they'll buy at the peak just before another drop. Here's a bit of practical perspective to keep in mind. With the 10-year Treasury yield sitting at around 4%, it's not putting too much strain on the government, the economy, or corporations. It's a manageable borrowing rate that still allows businesses to generate a solid return on their capital. Looking ahead to 2026, there are reasons to feel optimistic. Deregulation is on the table, the chaos from tariffs is mostly behind us, there's the potential for new tax cuts, and we could see stronger trade relationships globally. All of this could translate into higher earnings for American companies. Even though the market hasn't made a ton of progress so far this year, as of May, that just means there's still plenty of opportunity. Tons of stocks took a beating and haven't bounced back yet, which leaves the door wide open for investors. Whether it's Tesla, the big tech names like the Magnificent Seven, or even small cap plays, there's still plenty of value on the table. Tom Lee brought up several compelling points, but one that really hit home for me was his take on how market gains tend to be crammed into a short window, just about 20 trading days. Try to time the market and chances are you'll miss the most important moves. That's why I firmly believe holding on to assets like XRP for the long term is essential, especially in a moment like this. We're seeing real economic strength in the US, crypto is surging, stocks are rebounding, and confidence is running high. Amid all this momentum, Donald Trump is back in the spotlight, pressing Fed Chair Jerome Powell to start cutting interest rates. Trump argues it's unfair to keep rates elevated while other regions like China and Europe are easing. And honestly, he's not alone in that view. People have all kinds of theories about why Powell is holding back, and I'd love to know what you all think. Drop your opinions in the comments. But at the end of the day, there's a growing consensus rate cuts are overdue. The stage is set for a massive rally, and this bull market looks ready to kick into high gear. Even after the solid gains we've already seen, Trump is confidently predicting the stock market will climb even higher. That's bold, but what's curious is what we're seeing in the Kaoshi prediction markets. Following developments in the US-China trade relationship, the market now only anticipates 2 rate cuts in 2025, down from 3 previously expected. Why the sudden shift? It's not totally clear, but it likely ties back to the way Powell is framing his outlook. If you've caught any of Jerome Powell's recent comments, like those from the Fed Listen events or other speaking engagements, you'll notice he's sticking to the same script. There's no urgency to cut interest rates. That's been his consistent stance for the past 3 or 4 months. And here we are, nearly halfway through the year already. We've got about 6.5 months left in 2025, and if he's going to make any significant moves, the clock's ticking. To reach the previously floated target of 5 rate cuts, he'd have to lower rates back to back over the next few meetings, which, let's be real, seems highly unlikely.